All right, let's dive in. Today we are unpacking one of the most wild financial stories of our time, the GameStop saga. We're going to go way beyond the memes and the headlines to really get into the nitty-gritty market mechanics that allowed this whole thing to happen.
It all kicks off with this one number, a number that honestly looks like it shouldn't even be possible, 122.97%. Now, at its peak, this was the official short interest for GameStop. So think about that. For every 100 shares of the company that existed, almost 123 of them had been bet against.
And that right there is the big question, the puzzle at the heart of this entire thing. How on earth can you short more shares than there are in total? I mean, it sounds like it breaks the laws of physics, right? Well, stick around because we're going to figure it out together.
So here's how we're going to break it all down. We'll start with that 100% plus puzzle, get the basics of short selling down, and then I'll show you this thing called the share lending multiplier. That's the secret sauce. Then we'll look at how a squeeze gets lit on fire, put it all together with the GameStop case study, and finish with the moment the whole system almost came crashing down.
Okay, so first things first. We have to talk about short selling. Now, it gets a really bad rap a lot of the time, but it's actually seen as this super important, if not a little controversial, tool for figuring out what a company is really worth.
So here's the basic idea. You, the investor, borrow a share from someone, you immediately sell it at its current price, then you wait and you hope that the stock price drops. If it does, you buy that same share back at the new, lower price, return it to the person you borrowed it from, and you get to keep the difference. It is, pure and simple, a bet against a company.
And look, this isn't just people throwing darts at a board. There's a ton of research behind something called the short interest effect. What it shows is that, statistically, when a whole lot of smart investors are all betting against the same stock, it's a pretty strong signal that the company might be overvalued and that its stock is probably heading for a fall. And you know what? It works the other way around too. This data shows a strategy where you just buy stocks that short sellers are staying away from, the ones they aren't betting against, and historically that strategy has done really, really well. It kind of makes sense, right? If the people whose job it is to find bad companies aren't interested, maybe it's a pretty solid company. All right, so back to our big mystery. How do we get from that simple bet against a stock to a short interest of over 100%? Well, the answer is in this really fascinating kind of hidden mechanism in the market called re-hypothecation. It creates what you can basically call a share lending multiplier.
Let's walk through this step by step. So broker A lends one share to a short seller. That short seller then sells it on the open market to buyer B. Now here is the absolute key to this whole thing. Buyer B is now the 100% legal owner of that share. And because they own it, their broker can lend that exact same share out to a new short seller. And this is how it happens. A single, real share can be used to back up 2, 3, maybe even more short positions all at the same time. It gets lent, sold, relent, sold again. You get the picture. This isn't some back alley illegal scheme. It's a completely normal, structural part of how our modern financial markets are designed to provide liquidity. That's how you get past 100%.
So, when you have that much short interest all piled up on one stock, you've basically created a financial powder keg. It's just sitting there, waiting for a spark. And that spark, the thing that ignites a massive short squeeze, usually comes in one of two flavors.
First, you've got your classic equity squeeze. This one is pretty straightforward and happens right in the stock market. The second kind is a bit more complex. It's called a gamma squeeze, and it's born out of the wild world of options trading. The scary part? Both of them create these intense feedback loops of forced buying.
Okay, so let's dig into the equity squeeze. When you short a stock, it's not free. You have to put up your own money as collateral in what's called a margin account. Now, what happens if you're wrong and the stock price starts going up? Well, your bet is losing money and the value of your collateral shrinks. If it falls below a certain level, the maintenance margin, your broker calls you up and says you need more money. Now, that's a margin call. And if you can't pay, they force you to close your position by buying back the stock, which, of course, only pushes the price even higher. See the loop.
Now, the gamma squeeze, this thing can be even more explosive. This gets triggered when a massive number of people all start buying call options, which are just bets that a stock's price will go up. The big banks and firms that sell those options, the market makers, can't just sit there with all that risk. To protect themselves or hedge, they have to go out and buy shares of the actual stock. And that buying pushes the stock price up, which means their risk just went up again, forcing them to buy even more stock to stay hedged. It's this incredibly powerful, self-feeding upward spiral.
So that brings us to GameStop. This was the absolute perfect storm. It was a situation where you had insane levels of short interest, a classic equity squeeze, and a massive gamma squeeze all hitting at the exact same time. I think this quote just nails it. The market for this one stock was kerosene-soaked. You had a company that, Wall Street had largely given up on, and hedge funds had placed huge bets against it. The whole situation was just waiting for a match to be dropped. And the speed of what happened next is just mind-blowing. It really started simmering in mid-2020 with a couple of big-name investors saying, hey, there's hidden value here. But then, in early 2021, retail traders on Reddit's Wall Street Bets forum locked onto that huge short interest, and they started to organize. The result? The stock price just went vertical, from about $17 to over $480 in a matter of weeks, which led directly to that moment when brokerages just shut off the buy button. And that decision, the decision to halt buying, that's where this story went from being a crazy stock story to something much, much bigger. This became a genuine crisis in the hidden plumbing of our entire financial system.
You see, the real danger wasn't just that a stock was going haywire. The real systemic risk was that the clearinghouses, these are the central organizations that guarantee every single trade that happens. The fear was that they were about to buckle under the strain. If they go down, the whole market goes down with them.
And this right here shows you the sheer scale of the problem. On the morning of January 28th, the main clearinghouse, the NSCC, went to Robinhood and handed them a bill, a collateral call, for $3.7 billion, due immediately. This wasn't a fine, it was basically a security deposit they needed right then to prove they could cover all the insanely risky trades happening on their platform. The problem? Robinhood didn't have it. So that's why they shut off the buy button. It's called position close only. By stopping anyone from opening new buy positions, they could drastically reduce their risk profile, and in turn, reduce the amount of that multi-billion-dollar deposit they had to post. It wasn't about picking sides, it was an emergency brake to keep from flying off the rails and defaulting to the clearinghouse.
You know what's wild? After the dust settled, the experts couldn't even agree on what exactly had happened. The official SEC report came out and basically said the whole thing was driven by positive sentiment, kind of downplaying the role of a mechanical squeeze. But then a group of academics came back and said, whoa, not so fast, arguing that the SEC's math was off and that they'd seriously underestimated just how much forced buying from short sellers was really going on.
And the damage on the other side of this trade was absolutely brutal. The hedge fund Melvin Capital lost a staggering 53% of its entire value in 1 month. Citron Research, one of the most famous short-selling firms out there, lost 100% on their position and then publicly announced they were done, that they would never publish a short report again. This thing didn't just move numbers on a screen, it ended careers. So in the end, the system held together, but just barely. It bent, but it didn't completely break. And that leaves us with this huge lingering question. Our financial plumbing survived this one extreme stress test, but it showed us where all the weak spots are. Is it really ready for the next time millions of traders organize online in a digital flash mob to take on Wall Street? Honestly, I don't think anyone knows the answer to that. Thanks for tuning in.